Well, good afternoon, everybody. My name's Steve Hill of AIQ Systems. Thanks for joining me today in this session. Could be about 45 minutes long. Let me just set up my share screen here. If you could just type a Y in the chat area if you can see a cactus on the screen there. Thanks, everybody. It's been an interesting market the last few days, that's for sure. This session is primarily going to focus on what I've started to call choppy markets or trading the chop. Is it worth us attempting to trade when tickers and even the market itself is in a choppy situation? And I'll define what by that. But you can see on the screen here, we've got the spider at the moment, and I've annotated it with some real generalized trend areas versus what I call trading in a range. Now, trading in a range is not an exact science. This is a visual representation. You can probably see where a range begins. You can somewhat see where it begins, but only after the range has begun to form. It's not something you can go back and, for example, if I change the date on this chart back to the middle of December here, this doesn't tell me that I'm in a trading range up here. It looks like I'm just starting up a little bit of a pullback from this very strong trend. It takes a couple of what I call range bounds, upper and lower ranges, to form. And again, it's not an exact range, an upper or lower exact range, to give us an idea that we are in that trading range. So the question becomes, is that worth trading? Is it worth trading? Is there enough room in a range-bound market or a range-bound ticker or a range-bound ETF, whatever instrument you're trading? Is there a way of defining, A, is it a range? That's something we'll look at. B, what indicators are going to give me some insight as to what stage I am within a range itself? And we have a lot of indicators in our toolkits that are available that tell us a lot of different information, but not always give us the information we need, because we have indicators that show when there are pullbacks and show various other different aspects of any particular trading instrument. And our current marketplace, of course, in the summertime, a lot of traders have gone away. There are some traders who are in. There's a lot more retail traders in the market this summer than maybe before. Part of this is due to ongoing risks, systemic risks as far as oil prices, interest rates. There's also the AI, the technology that's been very volatile during this period. And one of the key things that has made a difference to retail traders, especially those who trade very actively, is the June ruling by FINRA, the Financial Regulation Authority, that allowed pattern day trading to disappear. Pretty much you can now jump in and out without having to do all that reporting, without any problems. And that's made a lot of difference to traders who like to be very nimble and therefore are trading over a very short period of time in and out, and don't have to worry about all that regulation that goes with that pattern day trading. Cap this with the huge volume on option premiums. There's just massive amount of options of trading out there. And we'll talk a little bit about that too, because I think there's a place for that in trading ranges. It's okay, sure, you can go long and you could go short within a trading range once you've identified that as a range, but maybe there's room here for options trading, because options gives us a little bit more flexibility to make money in a shorter period of time. So this is the spider, and again, this is obviously an uptrend that we had in place from April all the way up into November, December. You could make a case for saying that the trading range began back here, and we'll look at this one, and then also we'll look at the trading range that happened and has just broken out in the last few days during the last 2 months in this summer period. So I marked on this chart here, let me just move this forward a little bit. The trading range, you could make a case that it started back here, but this is looking more like a very much range that's turning down like this. So this could have been the start of a move to the downside. You don't really know you're in a range until you see this pattern where it's gone mostly sideways and it's pulling back and hitting a certain area. And again, it's not an exact science, a certain area where it keeps on topping out. You can see here, this is pretty much 1, 2, 3 different attempts at a high level here. And you could call this 1, 2, 3, maybe 4 different attempts at a lower level there. Now, when you're in the middle of that, right, when you're in the middle of that particular market conditions, getting in and getting out of positions requires tools that are designed to show us when we're overbought and oversold. And these are the sorts of things that we're going to be looking at. So the first area that really gives us some information. Two indicators I like to look at in here. And bear in mind as well, the more indicators we look for confirmation that are really designed for showing us these possible boundaries within a trading range. So the more of these indicators we put on here, the less likely we are to trade. So bear in mind, you're never going to get them all lining up together. My rule of thumb here is if I've got two of the indicators lining up with close enough to where I think the trading range is, that's good enough as a confirmation point that it might be flipping back from either the lower range or the upper range area. So one of the first things we can put on here, besides my crudely drawn lines, is a 21-day high and low. A 21-day high and a 21-day low, when it gets close to that, it's quite likely to turn around when it's in a trading range. And again, remember, we don't really know that until we've tried and tested this a couple of times. So here, maybe here is your first indication that this is truly a trading range that we're in. So if I put on, we have a 21-day high and a 21-day low, so that when prices are hitting either one of those, that's a particular, not an extreme point, but an extended point within the context of where price action is right now. So we'll just add those two on there for the moment. And you can see here, this white line is the 21-day high, and it works pretty well. But don't forget, we don't know we're in a trading range until we're in this area here. Because over here, look what happens when you're in a regular trend, whether it's upside or downside. Look how far away price action is from the 21-day low. And it follows the 21-day high up almost all the time. It's really sticking to it pretty solidly. This changed here, which is the transition period. Now you begin to see this price is getting closer to the 21-day low right here. And that's the indication you're probably in a range. Because this never happened, this happened back here, right? But you needed another pullback here before you could say this was a really good trading range. Maybe there, but this one's a better looking one. So at this point here, this is your first key off point that, oh, okay, maybe we are in a pullback here, and this is beginning of a trading range, in which case you would be trading, and if you just use 21-day low as your key off point, the next day you'd be in here until this thing got close to the 21-day high, and then you get out. This would be this is pretty good right here. This particular trade, then either you go short the day after it starts moving away from the 21-day high, and you stick with it until it bounces back to the 21-day low. And you repeat, and you can do this again once it gets up to the high, and then it comes back down again. So there's a definite pattern to trading this. Not many days that you're in this particular position. So you look at here, this is our first attempt to trade this range. We're looking at around about 680 on the spider. You're going to get a signal up here around about 696, and you're going to need to get out the next morning to 694. So it's not a huge amount. You gained a little bit of money during that period of time if you bought the spider outright. Then again, the flip side, if you went short here, you'd be out at the open here once it bounced off there, because that has happened overnight, unless you're going to watch it intraday, which you could, but that has its own idiosyncrasies. We're just going to stick with the end of the day. So you'd be out here around about 681, having gone short somewhere around about 694 for it's about 13 points. It's not a huge amount. It's still a little bit of a trade. You can see here, this is a relatively narrow trading range that's in place. Now, the key thing to remember here is what happens when this starts to become something other than a trading range. And that's when you get to this point here. So you could possibly have traded just using this without us going into any further indicators. You could have gone a short. Remember, this is our first reasonable point here. When we get to here is when we first realize that maybe we are in a trading range when it bounces off here. We don't know before that. We really don't know. But here you could have gone long, short. You could go long again. You get up here close to the 21-day, but it starts to fade. This is a sign that things might be moving away from the trading range and heading into a bit of a downturn, which is what's happening here. So the key thing here would be you'd probably get exited out for a very small gain on this one. And then you're looking at this going, oh, well, it's breaking out. Even my crude lines here, which I haven't extended, shows me that it's possibly broken out of that trading range. So within the context of our crude lines there and our 21-day high, look at how it works. We've transitioned from that sideways pattern. And we're just using the 21-day high. And it's a pretty good nimble trade environment is what I would call that within this specific framework here. And again, we're only in this period here. And so here we're now back into a downtrend. So our trading in a range has gone out the window. We are no longer, we have to wait for this to set up again before we can identify. We have to wait for this type of environment to reach this point here. So if we were just looking at 21-day high and low, it's pretty good. But maybe there are circumstances where you might want more confirmation. So what do we look at for that type of confirmation? What we're really looking at is a couple of indicators. ADXR is a good one to look at because it gives us overbought and oversold, and the average directional movement index. The trading channel index can also do good service for us in that area. And also the RSI Wilder is another good. So we're going to let's look at two of these. We'll look at the ADXR first, and then we'll look at the Wells Wilder, the RSI Wilder, to see what that looks like. So first up, ADXR, and let me pop that onto the chart here. It's right down here. So here's the key thing with ADXR. What we're looking for here is to be in a non-trending mode. This indicator is designed, the 20 threshold is, are we trending or not? But I don't care about that. The 25 is what we put in AIQ, which is when you're above 25, you're in a trending environment. That's really what it is. When you get above 25, and sometimes it oscillates down to the 20 and still stays in that trending environment. So it is pretty obvious looking at the spider chart here, when we're back over here, back in the middle of July actually of 2025, we're above the 2025, above 20 is still trending, but we like this to be up here for a strong trend. Look where the ADXR is and look where the trend is on the spider. Things start to break down towards the end of October 2025. We get seriously into the non-trending environment. And this is when we know we can be cautious and we can look at making these nimble trades in here. We could have looked in here at making the case for, here's our first hit down at the low. We know we're in non-trending mode. When we get back up to here, we still don't really know it's in the trading range, but maybe we're beginning to see it right here as our first instance. Maybe we're in a trading range. I highlighted this one here. You might have seen it here, but this is a little wider, so it makes it a little harder for us to analyze. But anytime you're in this non-trending mode is when a trading opportunity for us to trade a range comes into play. Notice what happens when the market shifts into a downtrend. Look at this, clearly going back into a downtrend here. We're in a mode where it's in a trend. There's no room for us to trade the range like we have up here. But this is a great one. I like this indicator, ADXR. It doesn't give us, it's not a timing tool. It's an environment of, this is a particular period of time or range of times when you should be thinking trading in a range or not trading in a range. And in this case, this area here was our opportunity. We're in a range. The other tool in there, the RSI Wilder, has a similar type of arrangement, but it deals with an 80-20, or is it a 70-30, isn't it? Let me find the RSI Wilder and we'll pop that on the chart here. Oh, where are we there? Let me hold down my control key and hit this one. So the thing with RSI Wilder, it's not often that many signals when we're in an overbought or oversold, especially in something like a market like the spider. I found that the RSI Wilder, and we'll see in a few stocks, there's a lot more information. But here, a key thing with the RSI Wilder is when it's above the 80% line, which is here, as it cuts down below, that's usually a sell signal. Over here is overbought, below the 20, sorry, over the 70, I keep saying the 80. Over the 70, it's in overbought, below the 30, it's in oversold. And you can see on the spider here, there's very few signals, and they don't seem to work that well on something like an ETF like this, which doesn't move quite like a stock. So I've discounted the RSI Wilder mostly. I've enjoyed using the new high and new low, sorry, 21-day high, 21-day low as a key off point for trading a range and making sure this ADXR is down in this non-trending territory. One other tool you can look at for timing these entries and exits within a range is to, let's get rid of the RSI Wilder. I'll bring it back on the stock and you'll see it does have some use in different types of instruments. MACD at a time can also be useful in this trading range area. Let me break out the ADXR so we can see this more clearly. Key thing here is the old adage of the divergence, right? Let me blow the chart up here. So we know I've got my crude range. I've got my 21-day high-low. We know that's a useful tool for some fairly nimble, taking a slice out of the market, both long and short. And by the way, on a short trade here, you can just switch over to the inverse ETF for that, if you like. That would have worked just as well. I'm not going to look at leveraged ETFs here. You could possibly use the 2 or 3 time leveraged ETFs to trade off this range here, but this is just purely in and out of a spider for the moment. If you look here, and again, this was pretty clearly the old adage divergence. Remember, this was our first key off point. When we got to here, go short. Do we see a divergence on the MACD? If I see that lining up with this range hit on the 21-day high, which I do see, MACD is clearly going down, right? Versus the 21-day high, the prices have gone higher, right? And look at the next peak over here. We've got the same thing happened again. So that's good confirmation. If you see them moving in sync, obviously that's what happened most often with MACD. But overall, this little trading range in here is easy to exploit with the 21-day high and a 21-day low. And MACD is good. And just double check that ADXR. Make sure you're not in this area and you're not in that area over the right here when we're in a very strong trend. So those are the key points off of the spider there. And once we've looked at some more of the stocks that are using this combination, as I said, you don't trying to make them all line up. It's never going to work. It's the old over confirmation. You keep putting more confirmation layers on, pretty soon you never trade. There's always going to be some risk of this, but when you have it look like this is tradable. So let's look at a couple of stocks. I've pre-prepared some of this beforehand to make it easier for us. First one up here. So this is Caterpillar, and what we have with Caterpillar is a couple of things going on. And this was a trading range that let me just move the date over to the right. And we will go back to Spider, by the way, and have a look at what's going on with the Spider currently. So this range started up over here, and you can see here it's you're clearly in a range. When you've come up here, you've been in a trend. This is definitely trending. You get this high point here, you come back here, you could come back, see how big the pullbacks are on Caterpillar. It comes back, takes a little longer, and then it bounces off again, and you get to this area here where you are in a trading range. So again, here would be your possible first kickoff. But again, the move up here is not fantastic. If you got in at the open here, 87.3, when it hit the 21-day high up here, you're talking about 94, 944. Actually, that's not too bad. It's a pretty good move. Again, you could kick off, go short until it comes back down to the 21-day low again, and repeat it and come up here. So in your trading range philosophy, right, you get out at the 21-day high when it hits that, which is around here. Doesn't matter that it continues hitting it up there. This is a trading range that we're in. Oh, how do we confirm that? We've got to put the ADXR on there just to make sure how long are we in the trading range for. You hold down a control key again, and notice here, this is what's interesting. Would you have traded this? Because guess what? It's not really in a trading range. It pops down in a trading range here. So you could say, hey, well, this is really still in trending. It's still in trending. And what's the key thing to look for with this is that it's just not big enough. When you zoom out a little bit, it's a bit of a sideways movement. But if you see this up here, well, we're still above the 25 level. You can find better candidates, even though, look at the peak here and the peak here. The MACD is clearly diverging down, which also confirms that this is going to pull away from there. But you can do better than this type of candidate because this is still in the trending range. So you'd probably skip that particular stock and move on to something else. Okay, so Salesforce it's got a lot of noise on this chart at the moment. So let me just remove the MACD a moment and the ADXR just so we can. So trading ranges again are messy. They're often messy. This is obviously a messy trading range here. It's not easy to define exactly what mode we're in until we put the ADXR on the chart itself. When I bring this on the chart, this area here, where it's in this range here, is definitely in the non-trending area. So we've got an opportunity. There's a little pop-up here, right? And you can see when we get into this area here, this is more into the trending mode. So opportunities also apply over here. It's in a non-trending area right here. Even though it's messy, it doesn't matter. Even though when we define my visual trading range, it's a very rough approximation. I need these other tools to give me some idea of when to trade this or not. So let's just focus on the most recent action here on Salesforce. And you can see quite clearly where the 21-day high and the 21-day low are defining some of the range here. At this point here in late February, we don't know. We think we're in a downtrend. We know that ADXR has popped down below 20 here. It's 25 is our good trend. And once we get in here, we know we're in trouble as far as trend is concerned, or in trouble as far as the downtrend is concerned. So when do we know we're in a trading range? Probably around about here, because it bounces back to here, breaking out of the trend, then it comes back to here. Now you get a little bit messy here. So at this point here, you might say, if I change my date to here, and this is where, again, using confirmation is useful. So I'm right here. Oh, maybe I am in the beginning of a trading range. So how do I confirm that? I've hit the 21-day low here. Is this my opportunity to go long? What about other confirmations like RSI Wilder? Is that going to give me any more information versus how poor it was at giving us any information on the prior chart? It does a better job on stocks. As you can see here, it does do a pretty good job. But right here, it's saying, okay, right here, this is a good opportunity. It's gone from oversold. You could have been in there, but you're not in the trading range yet. Here, it's never really hit that point. So though you're in a non-trending, here there's no confirmation again with RSI Wilder. If I put on the MACD and get rid of the RSI Wilder, do we see a confirmation here with MACD? We do. It's definitely got a divergence between there and there. Are we going to win all these? No, because what happens is you get in here and you'd probably get stopped out right here in this trading range because some protective stop would have taken you out for a small loss. Now, at this point here, what is your decision matrix? Well, the decision matrix is it's hit the 21-day low and it has been doing it here and here. Am I in a trading range or not? You're in a non-trending. You're just in a very floppy mess here. So I call this one. It's a very trading the chop is really what this is. Would I have tried again off here? It's possible. But the MACD now is moving in sync with the price pattern. So maybe I would have, this trading range really isn't panning out. It really isn't. So that's the type of decision you're going to have. Unlike SPY, where we had a possibility of 3 different trades, this one here, your first attempt is a fail. Because you see this break here, you probably have to wait for it to reform again. And the reason I put this up here is because it's messy. It makes it harder for us to determine whether it's a good one to trade. So you probably move on from Salesforce in this one and say, hey, well, it's in a horrible, messy range, but it's much harder to trade because I got failed out here. Once that's happened, once you get that happening, you look at this and go, that's not going to be easy to trade. The 21-day high versus 21-day low, when it's even or fairly even like it was within the SPY we looked at earlier, you've got a better confidence that you can trade it for a few trades. Eventually, it's going to break down, as has happened in the last few days with a lot of these trading ranges. It has broken down. Let's see what else we have in here so we can look at this in some more detail. Oh, so Nike, this was a good one. Let me just get rid of MACD a moment so we can see this better. So again, this is definitely a trend to the downside. The trading range isn't really confirmed until around about here. This isn't too bad. Again, you probably wouldn't have been able to identify it here. When I change the date to here, am I in a trading range yet? Looks like the beginning of it, maybe. Problem is, look at the ADXR. It's still looking at this as part of this, right? So that's not really the circumstance that we want. We want ADXR to be down below. You want it to be down here. Once it gets down here, you can say you're in a non-trending market. And that's exactly really what happens. You get down here. Now you can see this was non-trending before, but you wouldn't trade it because this was in the trending mode for the ADXR. Here it's a better circumstance. Of course, this is a little early in the game for it. You could have bought off here. You'd have probably stayed with it close to up to here. Not a great looking pattern. It's still not really easy to trade that. The MACD itself, what do we have off this bottom here, which is our first in non-trending? Do we have any information versus MACD? Not really. Here's the bottom here, and here's the bottom here. So not a lot that's confirming that. And RSI Wilder is the same thing. I think there's no into oversold territory. So this trading range looks like it's getting much narrower and therefore getting harder to determine if this is worth going for. You could have probably taken maybe one trade out of here and you wouldn't have made a huge amount of money on that. 40, you could have got in at, when it hit the bottom low here, you could have got in around about 45 the next day. You'd be hard pressed here at 44.42 to wonder if this thing is ever going to do anything. Getting close to the 21-day high, but it's not looking good. So that's not a great one. Next one I want to look at here is NVIDIA. Now, NVIDIA's had quite a few really challenging trading areas. This area here is quite good, and a quite good trading range right here. You don't know you're in this trading range until you're here. But then if you're just following the 21-day, do this again, change the date back to 122. This is the trend, was great trend here, non-trending here. We know we're in a good place to be if we want to trade the range for some short-term moves. And you could do that. Your first clue really is maybe here. You could trade off this up to the 21-day here. And again, you're going from about 172 up to 190 maybe. Then you could go short there until it hits back down at the low here. So 190 down to the 177 level. Again, nimble trades. If you're trying to buy and sell the stock, that's the way it would work. Still in non-trading, non-trending mode. I do mix up that non-trending and trading. If I bring in the MACD, what do I see for confirmation on this? This is our first point here. MACD is not really saying anything. It's in sync. That's the second one here. It's in sync too. The RSI Wilder, what do we see here? Again, you're not getting a lot of information. So I'm more and more inclined with the 21-day high and the 21-day low as being the most useful when ADXR is in place. And if I get an MACD divergence as well, that adds more confidence to the trades, possibly going in my favor. So as we move forward on this particular chart, we'll just take these out again. So again, coming down here, you definitely would be out of the trade here, taking up to hit the next 21-day high. This is only a couple of days, right? Then the next day you're going short again. You're like, well, is this going to work out? Don't know, because right here you're still in non-trading mode. There's nothing in the MACD or the RSI Wilder that's given me that I'm in overbought territory up here. So you might have just hung on to this until you got to this point here. Or you could have got out here and gone, as I said, you could have got out, gone short. What do I do here, right? I haven't reached anywhere near my 21-day. The low point there, if it went back up here, they've got to stop out, stopped out for a small loss. Again, you don't win them all, that's for sure. Again, 21-day high, come back down. You'd be out when you got close to the low here. This one would be, that's the close. You'd have got in at the open, gone short at 193.6. Here, you'd be out the next day at 180.79. Lots of nimble moves there, and then things break down over here. Things start moving back over into the trending territory. And that's just when it broke out of this, my self-imposed band. At that point, it looks like it's back into a trend. So again, it's ADXR's good 21-day high and low. And if we get an MACD, all the merrier. There's a good confirmation on this. So the trading range is very challenging to identify initially, but once you have the range in place, I just move up. We've got one more. No, actually, I've got PGD. This is a horrible choppy range. Look at the choppy range on Procter & Gamble. This is really very choppy chart. It trades between the range. We know we're in a range when we get to here. We're in a trading range, probably at this point around here. Maybe here is our first real indication that we're definitely in a range. We've been hitting this bottom area. You could have traded off of here until you got to the 21-day high. You're in a non-trending market. Popped out probably around about here for a couple of, if you're in here, 140.9, and you're out when it gets close to, sorry, you're in down here, actually. This is our first indication. This area down here, 140-ish, and then you'd probably want to get out of this area at 146. Still not a bad move. So when it follows it up like this, it's a little messy. You're like, am I going to go short here? Oh, let's do that. Well, look what happens. You get knocked around pretty badly because you haven't really come back up to this level here that you put in this line before. So this is where your self-imposed line, this line here, could I put that line in before? Guess what? No, because when I change the date back here, I don't know that this is a trend in place, right? A trading range in place. I might be saying this is where the range is it in here? So it's messy when it's like that. It's that first pivot off of here. When I put this line here, maybe this is a better line and I would have been knocked out here. And I would have considered, oh, well, okay. It looks to me like it's beginning to break out of that, out of this trading range itself. But what happens is, of course, is it comes back in my self-imposed line and I'm still in a non-trading, non-trending area. So in that case, the problem here is that any stock that I found that has gaps in price action like this one here tends to be a little more tougher to trade when it's in a trading range. Now we saw with the spider is a great example of, we're just showing Nike's another one. Nike was a much better opportunity. I'll go back to the spider in a moment, but non-trading, non-trending, right? This is back on the spider to the current data. You've got non-trading environment, non-trending environment. Must get that sorted out. Look at the thing that goes on here. 1, 2, 3. We'll probably get the inclination we're in a range right here. You could have traded this. You definitely have traded this one. This one you could have traded and you got knocked out here. The great thing with this is that there's lots of information in the price chart itself. If I bring up the RSI Wilder on here, I don't think RSI does us much good. We looked at this earlier, we don't get much out of RSI Wilder. The thing we do get out of this particular chart is that the new high, 21-day high and low really gives us a lot of it. So I really like the thing with indexes or spiders that mirror indexes is you don't get too many gaps. There is a little one there and there's a small one there, but they do tend to trade a little less volatile than obviously some of the stocks like we saw with DRM and Procter and Gamble. They're very messy. So really trading this sort of cues is not a bad place to be once you're in the non-trending market. One thing I would suggest is I would not be trading, say, this bounce. Let's look at some of these bounces on here in a little more detail. So, for example, let's say this area here, when prices go up to this area here, we're right up close to the 21-day high. Is at this point, you don't know if you're in a trading range or not at the moment. We just don't know that. You could make a case for it because you just about here, and then you. I'm sorry. Does someone have a question? If you could mute yourself, if you've muted yourself, that would be useful. Otherwise, I'll have to go in and mute everybody. So once you're here, you don't know really that you're in a range yet until you get to this point here. When I change the date to here, is this a range? You don't know. This is a pullback here. You're still in the ADXR is in the trending mode. We don't know we're in a range really or beginning of a range until we get to like this date here. We get to here and it bounces off here. And this is the opportunity right here. You're still, this signal line of the ADXR is the RBIT is above, but actually we're below the 25. So when you continue in this mode here, you have an opportunity to buy in here and watch carefully for this 21-day high level right here. Now I can draw in this line. Again, you have to be pretty crude with this. And this is your line in the sand. You might get out before that because you want it to get close to the 21-day high, and then you get out, right? And that's really what's happened right here. Opportunities are like this. You'd probably buy, you could buy out of the money option or an at the money option. So if you were here, instead of buying the stock, the ETF itself, say just after the open here, you could be, it's at 735 and 6. We know our level up here, you could buy maybe the 755 call, right? And go into that. The 755 call is the upper range of, or close to the upper range of where this range is beginning. So you have to look and say, well, how long out am I going to buy this call? I'm not going to buy today's call, right? Not enough time for moving. Looking at the number of bars, like 4 or 5 bars between this first section here and the second section here, maybe 5 or 6. If I buy here a call that's 6 to 7 days out, that's at the 750 or so level, then I've got an opportunity there for the price action to move in the trading range and then exit the position up here. Once you're up here and you're close to that 21-day high again, you're going to get out of that option and maybe you buy a put the next day around here at the 749, 750 level. If you want to buy at the money, that's fine. If you want to try and leverage and get a bit more out of it, think about the number of days, 5 to 7 days before we get back down in the range. So buy an option that expires out in that area and sit on it for a few days and see what happens. As you can see here, you get to here, you'd probably go, I think it's time to get out of that option. Again, if it's only 5 days out, 1, 2, 3, 4, 5, 6, 7, 8 days out, you might have got out here. Bear in mind how many bars there generally trades between the upper and the lower level in a range to dictate how far out you would buy an option. I did look at one actually. Let's give you an idea. This was buying a put actually on the spider back in June after it hit a top area on the 16th if you got into the option. And this, by the way, the price action I'm doing here, I'm buying the 724 puts, and they were out of the money at the time. And the expiration date was 625, and I was getting in on 616. So you can see the number of bars before expiration. It gives me time for this to move a little bit in the direction. And you can see it's options. And if it's out of the money, you got to be pretty prepared to lose 50% of your money in almost fraction of a few minutes or hours. But again, you could have stayed in it the next day and got out for a pretty good gain. I think this was close to, what's that, 272, even if you got in at 112. That's a pretty good move overall for a fairly safe option. If you'd stayed along, obviously you wouldn't stay all the way to the expiration because the option is going to lose a lot of its time value during that time. But even the day before or on 623, you were still looking pretty good for a gain on buying an option based upon the upper range of price action. So options are good. It's a good opportunity. This is in Thinkorswim, by the way, which is such a good platform for options. You can see here, again, it's where are we within a trading range? We know what's happened now, right? Look what's happened now. We've got to the stage where the ADXR is still in non-trending, but we've broken out up here. We've broken out of this area. It may well fall back in there, but we're still in a non-trend. It's just not enough time for it to get this look to it. So I really like the 21-day high and low, but making sure that the pattern doesn't keep moving away from us, because that's what happens when you get into a trend itself. When you get in a trend, it doesn't work. ADXR is our key. Got to be in this territory for it to work out. That's it. I'm doing some more stuff on the other things we can use to look at trending and non-trending, but I'm actually putting that into an article and maybe into an ebook as we're working on that. But are we back into a trend? This is a good question. We had a pullback today, right? This could just be a false breakout. We don't. And that's, again, this says we're not yet in the trend. Until that breaks up the top side, anything is possible. If you've got any questions, that's about it for me today. We're at our 5-minute mark. Pop the questions in the box. I'll send the recording out. There are opportunities, as you can see, especially with the spider. I like how the spider moves in these ranges here. And I do think options are a good opportunity to trade from these lower areas to the upper areas of the 21-day high, 21-day low. But you've got to be careful. You got to know when you're in this type of territory, because once you get into this, the whole thing doesn't work for you. Great. Thanks, everybody. If no more questions or got any questions, you can always email them to me, shill@aiqsystems.com. I will, as I say, post the recording up there, and we'll have some more sessions probably in September. Have a great evening, everyone.